video we're going to ask, is gold a good investment? And I'm going to take you through the rationale people have for holding gold and some of the problems with gold, so that when you're thinking about investing in gold, which I assume you are because you're watching this video, you can ask the right questions and be thinking about the correct things to make sensible investment decisions. And I'll just admit right now that I'm not the greatest bull when it comes to gold. So let's start with the absolute most important things that you must know before you even consider buying any gold. The first thing is it has no intrinsic value. Gold is worth what people are willing to pay for it. You can't get a financial calculator and calculate what gold is worth in the way that you could do for Coca-Cola or Nestle. Because if the value of Coca-Cola goes down a lot, and nothing changes in its business, you're just going to get a very high dividend yield, and you can buy more and continue to get a very high dividend and be invested in a very good business at a reasonable price. So something that you can value accurately going down in value is not bad. Whereas where gold has no intrinsic value, there's no sort of baseline that you can say that when it goes below this level it's good to buy. Gold also pays you nothing. Gold does not pay you a dividend. If you bought gold 100 years ago, put it in a safe, now you have exactly the same quantity of gold. This means that it can't compound, and in investing almost all of the returns you get are from compounding. But worse still, not only does it not pay you anything, it actually costs you to own it. If you buy physical gold, you're going to have to put it in a safe and store it, or pay someone else to store it in a safe. You're also going to have it insured. Maybe you're cheap and decide to dodge insurance to save a bit of money. Well, then you're taking a big sort of catastrophe risk. So there's a possibility of 100% loss, which is not a sensible way to go about investing. In investing, you should not be taking substantial risks. Success in investing is defined by not taking risk. High returns come from taking low risk. It's counterintuitive. You're told the opposite, but it happens to be true. This is the foundation of value investing. Gold is also cyclical and volatile. So gold can move a large amount in one day. It can move a very great deal in 1 year, up or down. You could say that volatility, you could call a kind of scariness. Things that are very volatile are quite scary to own, because you look at your 401k or your ISA or whatever, and you see the value moving wildly. And the problem is human beings react very irrationally to volatility and often go in the opposite direction than what they should be doing. So when it's going up, they think, oh, I'm making so much money, I'll buy more. That's why the price is going up. If people weren't piling into it, the price wouldn't be going up. And when the price is going down, people are getting out of it, because if they weren't getting out of it, the price wouldn't be going down. So people are always going against the market, going rather with the market, which is exactly what you're likely to do. And it is a terrible long-term investment, principally because it does not compound and it doesn't pay you anything. So just quickly review the different ways that you can invest in gold. You can literally buy physical gold, or you can buy it and have it stored in a safe in a bank. Quite expensive. You can invest in gold miners. Not something I'm enthusiastic about. Gold mining is an absolutely terrible business. Very often the business model consists of making a huge amount of money for 5 minutes and then spending several years losing all the money you've made. And then at the end of it all, you have a big hole in the ground and you have to go and find another mine that's going to be worse than the mine you just dug up. So it's not a great business model. And then the worst of the worst is what I would call the overpriced junk. This is the stuff that they try and push on TV. Gold coins, so there's not necessarily a market to sell them. Just trying to encourage you to panic and pay big postage fees to get your silly bit of gold. I would avoid these. These are the absolutely wrong way. If you're going to invest in gold, these are just the wrong way to go about it. There's far cheaper and far safer and far more sensible ways than buying mail order gold or anything like that. Also got derivatives. These are a bit more complicated but worth mentioning. And probably the most rational way, if you insist on buying gold, is an index, something like State Street. The costs are very low and everything's taken care of for you, and you can hold them in an account and just buy them on the stock market. They're the most rational way to go about it if you insist on investing in gold. So you should know what moves gold prices. Just quickly review this. So supply and demand: when lots of people are buying gold, the price goes up. When lots of people are selling it, the price is going to go down. Fear: when markets are plummeting, the money is going somewhere. One of the places it may be going is into the commodity markets. You also got central banks. They may be trying to sell very large quantities of gold or acquire very large quantities of gold, and since there's large quantities involved, that's going to affect the supply and demand equation. Yeah. Though, out of everything, if you remember one thing, this amazingly lazy graph, I haven't even bothered plotting all of the points, it would take too long, but the points of importance are always just the start and the end. So on the left hand side, on the y-axis, we've got real returns. So that's the sort of spending power that you would have if you'd made these investments between 1802 and 2006. So putting that money in stocks, you would have turned $1 into $755,000. This is mainly due to compounding and reinvesting the cash that you're getting, so you're acquiring more and more and more businesses every year, getting a larger chunk of American business. Whereas with gold, you've got exactly the same quantity, so you've made 95 cents in real terms, holding for over 200 years. So this really shows you the problem of not compounding. Gold can only really be used in the short term. You've got things like hedging, which is where you buy one asset to offset volatility or risk in another asset class. I'd say this is really only for sophisticated investors. It's quite complicated, it's difficult to do correctly, and you have to be disciplined in staying with it, which is one thing that novice and non-sophisticated investors don't possess. They're not disciplined. It's got low correlation with other assets. Typically, doesn't have to be in the future. Maybe something different will happen. They use it for diversification, because if you're holding stocks and then you're holding gold, you've got something that's not stocks. You've got something different. And of course, there's just wild speculation, just betting on where the price is going, which is not something I recommend. So let's just go through a quick summary. At the bottom, the most important thing: gold does not compound. I'm going to mention this twice because it's so very important. Charlie Munger, I think, summed it up perfectly in his very simple, straightforward way. He just says, civilized people don't own gold. I think you should remember that quote. I like it a lot. It is just an absolutely terrible long-term investment, which is what that graph shows you. Again, reinforcing the gold does not compound. It's speculative, it's high risk. The main reason it's high risk is because there's no sort of baseline from an intrinsic value perspective. And I'd really strongly suggest that you stick to stocks and bonds. In the long term, I'm very confident, and if you do your research, I'm sure you'll agree with me, that holding stocks and bonds is going to be better for you. So hopefully you've learned something about investing in gold. Perhaps I've put you off slightly. Though do your own research, and you're perfectly free to completely disagree with me. And thank you for watching.